Imagine two versions of the same week. In the first version, your car starts making a grinding sound on Monday. On Wednesday, your landlord reminds you rent is due. On Friday, your manager mentions budget tightening. You check your bank balance and feel your chest tighten. There is no cushion. Every small decision suddenly feels dangerous. You delay fixing the car. You avoid opening emails. You say yes to things you should negotiate because you cannot afford delay. That is survival mode. When cash is thin, your brain narrows its focus to immediate threats. Long-term thinking fades. Now picture the same week with one difference. You have $10,000 sitting in a separate savings account labeled emergency fund. The car noise is still annoying. Rent is still due. The office rumor still exists. But your internal reaction changes. You breathe slower. You compare repair shops instead of rushing into the first quote. You consider updating your resume without panic. The events are identical. Your response is not. This is the shift I want to explore. The first $10,000 is not about impressing anyone. It is a psychological and strategic threshold. Before it, life feels reactive. After it, you begin directing. Many people think wealth starts with investing genius or six-figure salaries. In reality, it often starts with stability. Stability gives you time. Time improves decisions. Better decisions compound quietly in the background. I am not presenting a dramatic rags to riches story. This is about building a simple financial control system that reduces stress and increases optionality. Calm mechanics, not hype. Clear rules, not guesswork. If money has ever made you feel rushed, cornered, or dependent on the next paycheck, this framework is for you. Over the next sections, we will break down why this number matters, what it changes in daily life, and how to build toward it step by step. Safety first, growth second. That order is everything. Let us define the real issue most people face. It is not a lack of ambition. It is a lack of shock absorbers. A household without savings is like a car without suspension. Every bump in the road feels extreme. A $600 repair, a medical deductible, a slow work month. These are normal events. They are not rare disasters. Yet without cash reserves, they trigger high-interest debt, stress, and long recovery periods. The number $10,000 is not magical by itself. Its power comes from what it represents. Runway. Runway is the number of months you can cover your life without new income. If your monthly expenses are $3,000, then $10,000 buys you a little over 3 months. If you live on $2,000 per month, that same amount stretches to 5 months. That buffer changes your risk calculations. An emergency fund is not investment money. It is not for vacations or gadgets. It is cash reserved for unknown but inevitable disruptions, job loss, health costs, urgent repairs. It belongs in a high-yield savings account where the principal is stable and accessible. The goal is liquidity and safety, not aggressive returns. Why does the shift feel so strong around this level? Because smaller balances help, but they often disappear in a single medium-sized event. A few $100s is helpful. A few thousand is better. But 5 figures begins to feel durable. You can fix the car, pay a deductible, cover a temporary income gap, and still remain standing. The deeper benefit is negotiating power. When you are not desperate, you compare options. You ask questions. You walk away from bad terms. Cash gives you pause, and that pause protects your future. This is the line between constant reaction and deliberate direction. If the logic is so clear, why do so many people struggle to reach this milestone? The obstacles are not only mathematical. They are behavioral. First, there is present bias. Humans naturally value today more than tomorrow. A small upgrade now feels concrete. Future stability feels abstract. So we justify daily conveniences that quietly erase the month's margin. $10 here, $20 there, a few subscriptions on autopay. None of them seem dangerous alone. Together, they crowd out savings. Second, there is debt friction. High-interest credit cards are especially aggressive. A balance at 18 or 20% annual interest works against you every single day. A $1,000 surprise can become far more expensive if it lingers. Interest compounds quietly. turning a short-term problem into a long-term drag. Then comes lifestyle creep. When income rises, expenses often rise with it. A raise feels like permission to upgrade housing, transportation, or dining. Without a rule, higher earnings do not automatically translate into higher savings. They simply inflate the baseline. There is also confusion. Financial jargon can freeze progress. Terms like brokerage account, deductible, expense ratio, or retirement plan sound complex. When people feel behind, they delay action entirely. Waiting feels safer than making a wrong move. Inflation adds another layer. Prices shift over time, so a fixed dollar goal can feel unstable. If everything costs more, saving can seem pointless. But the anchor is not a random number. It is months of expenses. Tie your target to your real life, not to headlines. The solution is not heroic willpower. It is reducing friction with a simple structure. When the structure is clear, progress becomes repeatable. And repeatable actions are what build real stability. So what is the structure that makes this practical instead of theoretical? It begins with automation. The day after each paycheck arrives, a fixed amount moves automatically into a separate savings account. Not at the end of the month. Not if something is left. The transfer happens first. This is often called paying yourself first, but the key is not the phrase. The key is removing the decision. Naming the account matters more than people expect. Call it emergency fund, not extra savings. Labels shape behavior. When the purpose is clear, you are less likely to raid it for random wants. Start with a small defensive wall. Many people aim for an initial $1,000 buffer. This stops minor emergencies from immediately pushing you into debt. While building that first layer, aggressively reduce any credit card balances charging double-digit interest. If a card is above roughly 10 to 12%, the math is working against you fast. Paying it down is like earning a guaranteed return equal to the interest rate. Once the quick buffer exists and high-interest debt is under control, the focus shifts to building the full $10,000 reserve. This money stays in cash. It is not invested in the stock market. It sits in a high-yield savings account where it earns modest interest but remains stable and accessible. This is the defensive phase. It may not feel exciting, but it changes your foundation. You are building a platform strong enough to support growth later. Skip this stage, and every market dip or surprise bill can knock you backward. Safety first, growth later. That order is the backbone of the system. Once the $10,000 threshold is reached, something subtle but powerful happens. Your relationship with money begins to change. Before this point, most financial decisions are defensive. You are trying to avoid overdraft fees, dodge late payments, or stretch the month. After this point, you start thinking strategically. You ask different questions. Instead of, "Can I survive this?" you ask, "What is the smartest move here?" Consider a simple example. Imagine your monthly take-home pay is $4,000 and your essential expenses are $2,800. Without savings, a $2,200 car repair likely lands on a credit card. At 20% interest, even modest minimum payments stretch the burden across many months. You are not just paying for the repair. You are paying for stress, lost flexibility, and future interest. With $10,000 in reserve, the same repair becomes manageable. You pay the invoice from savings. Over the next few months, you rebuild the fund through automatic transfers. No new debt, no compounding interest, no long-term drag. The difference is not just financial. It is mental bandwidth. When bills are not chasing you, your brain is free to focus on opportunity instead of threat. Research consistently shows that financial stress narrows attention and reduces decision quality. Remove the pressure, and clarity improves. This is where negotiating power also increases. You can compare quotes. You can walk away from poor offers. You can take a calculated career risk because you have time. Time is leverage. The milestone is not about hoarding cash. It is about stabilizing your base, so every future move is made from strength rather than urgency. Reaching $10,000 is not the finish line. It is the transition point. After this milestone, you define your full emergency target in terms of months, not dollars. 3 to 6 months of essential expenses is common. If your core lifestyle costs $3,500 per month, then 3 months equals $10,500. 6 months would be $21,000. The math should reflect your reality, not a headline number. Your emergency fund remains in liquid cash. Liquidity means you can access it quickly without penalties or market risk. A high-yield savings account is ideal because it protects your principal while earning modest interest. The purpose is stability, not aggressive growth. Now comes the structural rule. Once your chosen runway is filled, you stop piling extra cash there. Only refill it after a true emergency withdrawal. Everything above that line flows into growth automatically. Think of your finances like a reservoir with a spillway. Income fills the basin to a marked level, your emergency target. When the water rises above that mark, it spills into investments without requiring a fresh decision each month. This prevents both oversaving in cash and underinvesting for the future. You can also create small side funds for predictable but irregular expenses like travel, insurance premiums, or vehicle maintenance. These are not emergencies. They are planned costs. Separating them keeps your core fund intact. The power of this system is clarity. You always know which phase you are in, building safety, maintaining safety, or funding growth. Clear phases reduce hesitation, and reduced hesitation increases consistency over time. Once your safety layer is fully built, growth becomes the priority. This is where your money begins working independently of your hours. Growth does not require complicated strategies. In fact, simplicity is often more durable. A practical starting point is broad, low-cost index funds. An index fund is a collection of many companies bundled together, designed to track a market rather than beat it. Because it simply follows an index, costs stay low. The annual fee, called the expense ratio, matters. Lower fees leave more return in your pocket. Instead of trying to predict winning stocks, you own large portions of the overall market. A broad domestic stock index fund combined with an international index fund covers most publicly traded companies worldwide. If you prefer fewer decisions, a target date index fund automatically adjusts risk as you age. Risk and return move together. Stocks fluctuate in the short term, but historically reward patience over long horizons. Bonds tend to fluctuate less and provide stability, though with lower long-term returns. Your mix depends on your time horizon and comfort level. Longer horizons usually allow for more stock exposure. Automation continues here as well. Set a fixed amount to invest every month. This approach, often called dollar cost averaging, means you invest consistently regardless of headlines. When prices dip, your fixed contribution buys more shares. When prices rise, you buy fewer. Over time, the discipline smooths emotional reactions. Safety protects you from shocks. Investing builds momentum. Together, they create durable progress. A common question after reaching $10,000 is how to balance debt repayment and investing. The answer lies in comparing guaranteed versus expected returns. Credit cards with high interest rates are the clearest case. Paying down an 18% APR card is equivalent to earning an 18% risk-free return, something almost impossible to achieve in the market. Eliminating that debt first is usually smart. Student loans or auto loans with lower rates require nuance. If a student loan is 5 to 7%, you might split your extra cash, pay down a portion while still contributing to retirement accounts to capture employer matches. Employer retirement matches are critical. A 50 to 100% match on your contributions is essentially free money. Never skip this step, even while paying down moderate debt. The combination of debt reduction and matched investing accelerates both safety and growth. Behavioral factors matter too. Debt that keeps you awake at night may be worth prioritizing, even if the spreadsheet suggests a slight investing edge. Peace of mind is a real return, and sleep is valuable. Using round numbers helps make stakes tangible. For instance, $5,000 at 18% APR costs roughly $900 annually if you make only minimum payments. Paying it off turns that cash flow into growth potential instead of interest expense. Credit scores also benefit. Lower utilization improves your rating, reducing future borrowing costs. This reinforces the cycle. Safety and stability compound alongside invested growth. By clearly separating runway from growth money, and by tackling debt methodically, your financial system begins to operate automatically, with fewer reactive decisions and more deliberate moves. Life is not a spreadsheet, and numbers alone do not capture reality. Your emergency fund, debt repayment, and investing plan must fit your personal circumstances. If your income fluctuates, like with freelancing or sales, extend your runway. 6 to 12 months of expenses may be necessary to cover slow periods without panic. If you have dependents, factor in childcare, medical needs, and insurance premiums. For renters, include sudden moves or deposits. Homeowners must account for deductibles, repairs, or the possibility of selling a home. Even with access to a health savings account, HSA, keep the core emergency fund in liquid cash. Market fluctuations should not collide with immediate medical needs. Relocation is another moment where a substantial runway pays off. Deposits, travel, overlapping rents, interviews, and temporary time off all require cash. With a proper buffer, you choose timing instead of reacting to circumstance. Inflation makes fixed dollar goals slippery, so anchor your target in months of expenses. Review it periodically, once or twice a year, and adjust for lifestyle changes, cost of living increases, or new responsibilities. Consider overshooting the minimum if you anticipate higher risk periods, like starting a business or switching careers. A thicker runway buys options, and options improve your odds of favorable outcomes. The underlying principle is simple: runway equals options, and options equal better decision-making. Protect the runway first. Only after safety is established do you step confidently into growth. The $10,000 milestone is not an endpoint. It is the turning point where proactive, planned, and deliberate action replaces reactive, stressed decision-making. It is the beginning of a system you can trust. After crossing the $10,000 mark and establishing your emergency target, the final step is creating a system that runs itself. Automation is your ally. Your paycheck should flow predictably. Bills from checking, emergency fund top to target, and any surplus automatically directed into investments. This removes decision fatigue and ensures consistency, the real engine behind wealth building. Set simple rules for emergencies. Define what counts as a true emergency, how to refill the fund afterward, and how growth money is allocated. Keep it short. A few clear sentences are enough. Combine this with periodic reviews, monthly or quarterly, to confirm transfers ran, balances are on track, and debt is under control. These check-ins prevent complacency and maintain momentum. As your income rises, consider a structured approach to raises. Allow a modest lifestyle increase, but channel the rest into savings and investments. This keeps progress enjoyable while compounding accelerates in the background. Keep learning in small, manageable bites, an hour a month on books, podcasts, or courses. Knowledge builds confidence, and confidence reduces reactive choices. Finally, make your runway visible. Write your current months of coverage on a sticky note or a financial dashboard. Seeing it daily reinforces that money is a tool, not just a number. Each curveball life throws becomes a chance to respond with a plan instead of panic. Your system, built on safety first, growth second, ensures that $10,000 is more than a milestone. It is the start of a durable, flexible, and stress-resistant financial journey.